Imagine earning 9.5% yield while having your money safely invested across 10 European countries, all from the comfort of your Singapore brokerage account. Sound too good to be true? Well, grab your Kopi and let's talk about the investment opportunity that's been flying under the radar for most Singaporean investors. Stoneweg European Real Estate Investment Trust. Welcome to the Kopi Notes, where we break down complex investing ideas into practical wisdom you can use. Today, we're exploring how adding a slice of European real estate to your portfolio might be the diversification move you didn't know you needed. Section 1. Why Singaporean investors should consider European real estate exposure. Most Singaporean investors have their portfolios heavily concentrated in familiar territory local REITs, banks, and perhaps some regional Asian stocks. But in today's interconnected global economy, this regional focus might be leaving money on the table. Stoneweg European REIT offers something truly valuable: genuine geographical diversification outside the Asia-Pacific region. Here's why this matters. First, economic cycles in Europe often move differently from Asian markets. When Singapore's economy faces headwinds, parts of Europe might be thriving, and vice versa. This negative correlation can help smooth your overall portfolio returns. Second, the euro provides currency diversification against the Singapore dollar. As we've seen in recent years, currency movements can significantly impact returns, and having euro exposure can act as a natural hedge. Third, Stoneweg offers an impressive forward dividend yield of 9.53%, substantially higher than many S-REITs focused on local assets. In today's low-yield environment, that's nothing to sneeze at. But perhaps most importantly, European real estate markets operate under different fundamentals, regulations, and growth dynamics than what we're used to in Singapore. This provides not just diversification, but access to opportunities that simply don't exist in our local market. Section 2. Understanding how European REITs differ from S-REITs. Before you rush to invest, it's crucial to understand that European REITs operate differently from our familiar S-REITs. Stoneweg European REIT follows Singapore's regulatory framework since it's listed on the SGX, but its underlying assets are governed by European regulations. Key differences include: European property markets typically have longer lease terms, especially in the office and industrial sectors. This means more stable, predictable income streams, but potentially slower rental growth adjustments. The asset focus is also different. While many S-REITs concentrate on retail and office properties, Stoneweg targets light industrial, logistics, and core office assets in gateway cities across Europe. This sector focus positions the REIT to capitalize on the e-commerce boom and the increasing demand for logistics facilities, a trend that shows no signs of slowing across Europe. Section 3. Demystifying euro-denominated assets and currency risk management. But what about currency risk? I hear you asking. Let's break it down in simple terms. When you invest in Stoneweg, you're buying euro-denominated properties, but your dividends are paid in Singapore dollars. This creates both risks and opportunities. If the euro strengthens against the Singapore dollar, your returns get a boost. If the euro weakens, your returns may take a hit. But here's the smart part. Stoneweg's management employs strategic currency hedging to mitigate excessive volatility. They don't eliminate currency risk entirely, that would be expensive and counterproductive, but they smooth out the worst fluctuations. For Singaporean investors with portfolios heavily weighted in Singapore dollars, having some euro exposure can actually be beneficial as part of a broader diversification strategy. Section 4. How European REITs complement a Singaporean REIT portfolio. So how exactly does Stoneweg fit into your existing portfolio of Singapore REITs? First, geographical diversification. Stoneweg gives you exposure to properties across multiple European countries, including the Netherlands, Italy, France, Poland, Germany, Finland, Denmark, Slovakia, the Czech Republic, and the United Kingdom. That's 10 countries in one simple investment. Second, sector diversification. While your Singapore REITs might be heavily weighted toward retail, residential, or local offices, Stoneweg focuses on light industrial, logistics, and core office properties in Europe's key cities. Third, yield enhancement. With its forward dividend yield of 9.53%, Stoneweg can potentially boost your portfolio's overall income generation. And fourth, different economic exposure. European markets respond to different economic drivers than Singapore, providing genuine diversification when you need it most. Singapore's REIT market has evolved significantly, with 80% of S-REITs now having some or all of their properties outside Singapore. Stoneweg is part of this internationalization trend, but with a focused European strategy. It's easy to understand and access. Section 5. Comparing yields and growth potential. Europe vs Singapore real estate. Let's talk numbers. How do European REITs stack up against Singapore REITs when it comes to yields and growth potential? Currently, Stoneweg offers a forward dividend yield of 9.53%, which is on the higher end compared to many Singapore-focused REITs. This yield premium exists for several reasons. European commercial real estate, particularly in certain markets, often commands higher cap rates than prime Singapore properties. Additionally, the European real estate market has been recovering unevenly post-pandemic, creating opportunities for REITs like Stoneweg to acquire quality assets at attractive valuations. In terms of growth potential, European logistics and light industrial sectors are benefiting from structural tailwinds including e-commerce growth and supply chain reconfiguration. This positions Stoneweg's portfolio for potential capital appreciation beyond just dividend income. Section 6. Tax considerations for Singaporean investors in European REITs. Now, let's tackle something that often gets overlooked but can significantly impact your real returns. Tax efficiency. Here's the good news for Singaporean investors interested in Stoneweg. Since Stoneweg is structured as a Singapore REIT listed on the SGX, distributions to Singaporean investors are not subject to additional withholding taxes that might apply if you invested directly in European property companies. The REIT's management team actively works to optimize the tax structure at the property level across different European jurisdictions, which helps maximize the distributable income to investors. For individual investors in Singapore, dividends received from Stoneweg are generally not subject to income tax, maintaining the tax advantages you're accustomed to with local S-REITs. As always, tax regulations can change, so it's advisable to consult with a tax professional for your specific situation. Section 7. Accessing global real estate without leaving Singapore. One of the most compelling aspects of Stoneweg is how it provides access to European real estate markets without the complexities of direct overseas property investment. As an SGX-listed REIT with the ticker CWBU.C, investing in Stoneweg is as simple as buying any other Singapore stock through your regular brokerage account. This means no need to open foreign trading accounts, no direct exposure to foreign property laws, no need to manage overseas property managers' liquidity that direct property investments simply can't match. With a market capitalization of 882.955 million SGD and an average daily trading volume of 180,970 shares, Stoneweg offers reasonable liquidity for most retail investors. This accessibility makes it an ideal vehicle for Singaporean investors looking to dip their toes into European real estate without the headaches of direct ownership. Section 8. Recession resilience. European residential and logistics assets as safe havens. In today's uncertain economic environment, portfolio resilience matters more than ever. This is where Stoneweg's asset mix becomes particularly interesting. The REIT's focus on light, industrial and logistics properties positions it well during economic downturns. Here's why. E-commerce fulfillment remains essential regardless of economic conditions, providing a buffer for logistics properties. Light industrial properties often house essential businesses that continue operations even during recessions. Core office assets in gateway cities, while more cyclical, tend to recover faster than secondary locations post-recession. This combination creates a portfolio that's designed to weather economic storms while still capturing upside during recovery phases. For Singaporean investors who may have significant exposure to more cyclical sectors like retail or hospitality through their local REIT holdings, Stoneweg offers a complementary profile that can potentially smooth overall portfolio volatility. Conclusion. As we've explored today, Stoneweg European REIT offers Singaporean investors a unique opportunity to diversify beyond local markets while still enjoying the familiar structure and convenience of an SGX-listed REIT. With its focused strategy on European logistics, light industrial, and core office properties, attractive yield profile, and built-in geographical diversification, it represents a compelling complement to a traditional Singapore REIT portfolio. As always, Investment decisions should align with your personal financial goals and risk tolerance. But for investors seeking to broaden their horizons beyond Singapore's shores, Stoneweg European REIT deserves a closer look. Disclaimer: this is not financial advice. This is the Kopi Notes, where we turn complex investing ideas into actionable insights. If you found this analysis helpful, please hit the like button and subscribe for more practical investment wisdom. Until next time, happy investing.